Welcome to the cutting edge of the global awakening.
In the councils of government, we must guard against the acquisition of unwarranted influence by the military-industrial complex.
Well, it looks like the North Tower of the World Trade Center has just completely collapsed.
The U.S. dollar's status as the preeminent reserve currency is under attack.
This is a mathematical fact. Tens of trillions of dollars are being extracted from the United States of America.
You really want the truth? Then just follow the money.
Welcome to Follow the Money Radio, a broadcast dedicated to your personal, spiritual, and financial liberty. And now, here's your voice of reason in the midst of global chaos, economist and best-selling author, Jerry Robinson.
All righty, friends, welcome to this week's program. So glad to be back with you after taking a week off. Woo! Jay did a good job last week. Jay Peroni, certified financial planner. He was here sitting in for myself as I was completely indisposed last week. What an interesting opening that our team has made for this program, this idea of welcome to the edge of the global awakening. I think that's a very accurate type of description of what this show really intends to be. We certainly want to provide you with financial advice and financial literacy and education. That's certainly our number one goal, because we feel that many people have gotten themselves kind of tied up in knots. They have got themselves perhaps underneath a very heavy amount of credit card debt, or maybe they've got a very large mortgage, or maybe they have just too much in consumer debt, student loans, whatever the case might be. Others maybe don't have too much debt, but they don't know how to invest the money that they have been entrusted with. And so this show is really all about, helping untangle all of those things. And when we say the global awakening, what does that mean? Well, it all depends on your definition, but in my mind, what we're seeing today all across the globe is a massive global awakening as people wake up to all kinds of new ideas. And really what has caused this is the flow of information. The information age that we're living in today is just unbelievable. Who could have dreamt that we would have email and internet and cell phones and smartphones just 20 30 years ago? I remember whenever I was growing up not having email, not having any kind of smartphone at all, and no iPad, no tablet, even the PCs were, pretty antiquated. They weren't really useful for anything much besides playing some really boring games or for productivity. And today, of course, they've become tools in this new information age for researchers. And wow, what just an amazing time that we truly are living in. But it's also a very dangerous time that we find ourselves in as we look around the world and we see, nation rise against nation and kingdom rising against kingdom. And we see all these things that were foretold in the Bible, so long ago, back in Matthew chapter 24, which is called the Olivet Discourse by theologians, where Jesus Christ talks about what is coming. And we're living in a time right now, in a day right now, where many of the things that were prophesied in the Bible are coming to pass in our very own lifetimes. I'm even reminded of Daniel chapter 12, verse 4, where it talks about that in the very last days, men would go to and fro and knowledge would be increased. My goodness, that's certainly been very accurate. So I approach money, I approach all of these topics from a faith-based perspective as I research and as I focus on things. And I really believe that we're living in a very unique hour, a very unique time. And part of our stewardship, not just taking care of our families and taking care of all of the normal, day-to-day things that all of us need to take care of, another major part is taking care of the money that has been entrusted to us, taking care of that money, stewarding it, using it wisely, And that includes not just investing, but it also includes saving. It also includes, being smart in how you earn money and maybe even developing multiple streams of income. It's also giving and donating and helping those who are less fortunate than ourselves. So certainly economics and finance is the main thrust of this program, but also we like to talk about geopolitical events because those now today are having a tremendous impact upon the markets. We saw this week that Israel launched aerial strikes against Syria, apparently hitting a military research center in that country. There was several people dead and wounded. But, Syria is a very threatening nation to Israel with many of its, unknown, uncertain elements within it that seem, just hell-bent on causing chaos in the region. And so when that occurred, when the strikes on Syria occurred by Israel, you could see the price of oil, West Texas Intermediate crude and also Brent oil rise pretty quickly on that. And so oil has kind of spiked this week after kind of being in the doldrums for the last couple of weeks. But again, geopolitical tensions certainly play right into economics. And finally, we do talk about spiritual topics on this radio show as well, and I think you're going to hear a lot more of that as we move into 2013. And part of the reason is because I'm feeling a strong urgency in my heart and in my spirit to share more spiritual topics on this program. And I hope that many of you who have been listening to us for a long time are looking forward to that. I hope so, because I certainly am. I'm looking forward to sharing spiritual concepts, spiritual ideas that lead to spiritual freedom, in addition to financial concepts that lead to financial freedom. So that's really what this program is all about, is freedom. And freedom and liberty are just kind of on the decline today. We're certainly seeing freedom in the United States and many of the Western nations under attack by, out-of-control governments. We're certainly seeing that. And then we're also seeing people living in bondage to all kinds of financial ideas that have been foisted upon them by corporations and financial institutions and through ads and commercials and billboards. And so, many of us are living lives that really aren't our own. We've just kind of bought into the whole American dream or the American mentality. And so, hopefully some of the material that we're providing you on this program and on our website and on our Facebook page and on our email blasts and all of that and our webinars are designed and provided to help you break free, to experience true freedom. So that's really what this program is all about. And I want to get started this morning on this program by I want to talk a little bit about the webinar that Jay Peroni and I held this week. It was really a great webinar. For those of you who missed it, it is available up on our website. You can just simply go to ftmdaily.com and you'll see it right there on the front page. It should be one of the posts, one of the most recent posts that we provided a link to this webinar. You can watch it in its entirety. It's about an hour and a half. We talk and provide a lot of education on technical analysis, how to look at a stock and actually know when it's time to enter and when it's time to exit using different type of technical indicators. And that's all explained there on the webinar, in full living color. You can watch it and see it as we show different charts and kind of explain what we're doing when we enter and when we exit those stocks. Jay also provided 7 stocks that he believes could outperform over the course of the next 30 days. That's kind of a fun segment on the webinar, so you might want to check that out, at least especially if you're looking for new stocks to add to your portfolio in this raging bull market that we are in. Then it'll give you some ideas on some of the stocks that he's looking at. Jay Peroni runs our PACE investment portfolio, the PACE, P-A-C-E, precious metals, agriculture, commodities, and energy. It's a 20-stock portfolio that's composed of all 4 of those elements, some of the best precious metal stocks, agricultural stocks, commodity stocks, and energy stocks. And then it's cushioned and surrounded with dividend-paying companies that are defensive in nature to provide a buffer for times whenever, the ebbs and flows that occur, obviously, in the hard assets market. So overall, the PACE portfolio is doing very well this year, and we're enjoying some of the gains, especially in the energy sector. Jay also talks about the importance of using small cap stocks to gain access to this raging bull market. If you take a look over the course of the last 6 or 7 major periods of inflation in the United States, what you'll find is that small caps have beat the tar out of large cap stocks over the periods of inflationary times. And so when we say small caps, what do we mean for new investors? Well, basically smaller companies, and not just smaller companies, smaller value companies, small cap value companies, as opposed to small cap growth companies. Very interesting information that was presented in the webinar, and you can check that out there on our website. He also provides 5 different economic trends that he is watching, and he provides about 15 stock ideas there. So there was just a ton of information lined out in the webinar that was held this week, and I encourage you to go check that out. If you're interested in stock investing, interested in improving your stock trading, or any of that at all, that's a great free resource, an hour and a half long, that you can go and watch, take notes on it, and if you have any questions, always feel free to send those in to us, and we will get to those as soon as we can. Jay is up on deck. I'm going to bring him on in just a minute. He has a stock idea of the week lined up. This time it's coming from his Tomorrow's Treasures portfolio, which is a portfolio for those who are looking for the up-and-coming stocks that could really outperform over the course of the next 5 to 7 years. And so we're going to begin a new monthly, or I guess a month-long segment of him sharing his Tomorrow's Treasures ideas. So we'll probably get 4 or 5 of those before we move on to a different portfolio that he runs. Also, I want you to know that we have an interview coming up with Professor James Galbraith. He is a professor of economics at the University of Texas in Austin. He is a Keynesian, which is the polar opposite of what I am. Even though I was instructed and taught in Keynesian economics, I quickly broke free from that. And the name of the book that he recently wrote is called Inequality and Instability, A Study of the World Economy Just Before the Great Crisis. Dr. Galbraith is going to make the case that what we need in America right now is more regulation and more government. So obviously a Keynesian, and then his kind of give you a sneak peek. One of the things that he actually says in his book that would actually help the economy is to raise minimum wage. And I'm sure he'll say that in the interview, that we should raise the minimum wage across the country on a federal level. Now, any of you who are running small businesses, you know that a raising of the minimum wage, it's just going to mean that you can have fewer employees. It doesn't necessarily lead to more prosperity. It leads to higher labor cost, which means that companies cannot afford to employ as many people. So it's just kind of backward logic with the Keynesian, but I will let Mr. Galbraith speak for himself. We don't like to pigeonhole certain types of views and say, well, they're not welcome on Follow the Money Weekly. We like to bring them on, and if we disagree with them, we disagree with them. I like what one of the founding fathers said, it neither breaks my leg nor picks my pocket, and that's exactly how I view with this. He's welcome to his opinion, and we will certainly hear him out. We're going to have a macro update. I'm going to provide you with some basic information about what's been happening around the globe and the markets. We're going to go to that, but first I want to bring Jay Perrone on with his investing idea of the week.
Jay Perrone, certified financial planner, here with the idea of the week. This week we'll take a look at a company that is innovating and changing the world around us. The Tomorrow's Treasures portfolio focuses on finding tomorrow's leading companies today. In order to spot trends, I look for companies that are innovating and changing the world around us. Imagine getting in on a company like Apple before they mass-produced the iPod. Or what about Tesla Motors before electric cars were a reality? You get my point. Getting there early can lead to huge profits. One of my favorite areas of innovation right now is 3D printing. After decades of development, which was once reserved for science fiction movies, is now a possibility. Remember the Jetsons? Many of those technologies are now possible, 3D printing being one of them. Additive manufacturing is finally getting a lot of publicity. This is quickly leading to strong demand and profitability for firms in the 3D printing space. One of my favorites in this industry is Stratasys, ticker symbol SSYS. Stratasys manufactures 3D printers that allow engineers and designers to create working prototypes of CAD design models. The company also generates roughly 1/3 of revenue from its on-demand parts manufacturing business, which delivers parts printed on 3D printers for customers that send a CAD file. Here are 3 reasons why I like Stratasys. Number 1, its recent acquisition of Objet makes Stratasys the largest manufacturer of 3D printing equipment for the professional market. This is a rapidly expanding market, and in the future this could be one key market segment for Stratasys. Number 2, the company has a very impressive track record of both growth and profitability and being able to survive in both up and down market cycles. Number 3, the company's singular focus on plastic should make it the leader in the 3D space. This should also allow it to carve out more profitable niches, potentially blocking future competitors. Stratasys is a good buy up to $85 a share. This company's delivered a 22% annualized return over the past 15 years, and I do not see this trend slowing down. Again, that's Stratasys, ticker symbol SSYS, worth a closer look. This is Jay Peroni, Certified Financial Planner, signing off for the Idea of the Week. We'll see you again next week.
All right. Well, Jay Peroni is a CFP, Certified Financial Planner, a member of our Christian Financial Advisor Network, and he also manages our very own PACE investment portfolio. If you would like to have a free 30-minute review of your investments with Jay, you can call him at 888-664-6963. That's 888-664-6963. And when you do, be sure to tell him you heard about him on Follow the Money Weekly Radio.
How can you find tomorrow's most profitable stocks before Wall Street finds them? Well, many investors are searching for a place to find stocks that can turn a nest egg into a huge fortune. Since 2009, the Tomorrow's Treasures portfolio has produced annualized gains of 28%, turning a $10,000 portfolio into $21,300. Small cap stocks have had an impressive run over the past 87 years. In fact, small cap stocks have produced 12.1% annually compared to just 9.9% for large cap stock, according to research. Now, this may seem like just a measly 2.1% each year, but the compound effect over the years is astonishing. Consider this: $10,000 invested in large cap stocks in 1926 would be worth $30 million today. Pretty impressive, right? But $10,000 invested in small cap stocks in 1926 turns into over $160 million. Simply put, if you want to build a fortune over the next decade, you must invest in small cap stocks. In fact, all of the top 10 performing stocks of the past decade were small cap stocks. Chances are the top performing stocks over the next decade will also be small cap stocks. So how can you build a fortune? Well, there's no get-rich-quick formula, but good old-fashioned discipline, hard work, and a thorough screening process can pay huge dividends. That's why the Tomorrow's Treasures portfolio was created to help you find the best small-cap stocks today. By investing in underfollowed companies before Wall Street analysts catch on, you can stand to make substantially higher gains as the market drives up share prices. Get started today. Learn how to crush the markets using small-cap stocks. The Tomorrow's Treasures portfolio service may just be what you're looking for.
Well, you've probably heard that old saying, sell in May and go away when it comes to the stock market. And I believe Jay Peroni last week on the program talked a little bit about the concept of selling in May and going away. And in fact, most stock analysts, when they've been surveyed as of late, have said, no, now is not the time to be listening to that proverb because the market is going to continue to rally through May, June, July. So overall, the concept or the idea of selling in May and then going away and waiting to buy back into the market later is not really being accepted this year. However, it certainly has worked. But there's an interesting fact that was put out by Bespoke Investment Group last week that caught my eye. I wanted to share it with you this week. And I'm quoting, it says, over the last 30 years, an investor who bought the S&P 500 index every October 31st and then sold the following April 30th, so that's basically selling before May comes around, they would be up 898%. 898% if they had just bought the S&P 500 index, maybe through an ETF like ticker symbol SPY, and held buying on October 31st and then selling on April 30th. Every single year, just doing that, they would be up 898%, and they would only be in the market 5 months out of the year. But in contrast, someone who bought every April 30th and then sold in late October and they held the other 7 months of the year, they would only be up 56% over that same 30-year time period. It's a really big difference. So it shows you that sometimes the concepts are really rooted in something that is very true. So the sell in May and go away concept is, I believe, a pretty historically accurate one. However, this year, it's just not panning out that way, at least not yet. I want to go around the globe real quickly and talk about some of the action in many of the different stock markets. You know, U.S. stocks currently are in a massive uptrend, and we actually use something here at FTM Daily for our FTM Insiders called the FTM Market Conditions Indicator. And it's an indicator that I developed, and we use 52-week highs, 52-week lows. We use insider buying, insider selling. We take a look at a few other metrics. And what we do is we create this system to where it tells us what the market is currently doing. Now, we don't care necessarily when you turn on the talking heads on TV and you hear CNBC and you listen to Bloomberg. Everybody has an opinion on where the market is going. They think that the market is going to go up, or they think the market is going to go down. And those are all, that's good. That's what they're probably paid to do. But the very best way to invest in the market is not to listen to all the conflicting opinions, and usually it's just kind of sales advice mixed in. And instead, it's much better to actually pay attention to what the markets are doing. That's why we call the show Follow the Money. We focus on what is actually occurring in the marketplace. What is the supply? What is the demand? Therefore, we have developed, it's not a really unique system in the fact that we use the red light, yellow light, and green light. I think other systems probably use something similar. What makes our system unique is that it has been so accurate for so many years. It called the 2008 crisis right before the massive drop. I can still remember to this day, I was out speaking in Denver at a conference, and the market tanked the following week, and our metrics and our indicator had said, sell now, get out now. And of course, it was just a big free fall. It saved me quite a bit of cash. Also, there was another recent downfall in the stocks, and our indicator light showed us to sell ahead of time. It turned red, indicating tighten your stops, get ready to move to cash and to the sidelines in the event that you need to. And so, regardless of all of that, the point is that this system is telling us right now that the light is green. It's saying buy, buy, buy. Take on new positions and continue, because the rally is intact. And that's what we're seeing as we look out. We are seeing very strong rallying going on around the world. And you know why. It's because the Federal Reserve is pumping in money. It's because the ECB is lowering rates and offering money into the system. The Bank of England has been putting money in. The Bank of Japan is the one that's just amazing. $79 billion in essence is what they're putting into their economy every single month. And that's, when you think about how small their economy is, relatively speaking, to the United States, you discover the U.S. is putting in $85 billion a month. Japan's almost putting that much in. So it's like 3 times, Japan's about 3 times smaller than us. So it's about 3 times more powerful to their economy. So we don't know what kind of uncharted territory they're going to end up in. Right now, the Nikkei average, the Tokyo stock market, is just rocketing forward. It's unreal. So it's skyrocketing. And we obviously have been saying that Japan would eventually rise because of that monetary easing, and we're certainly seeing it. We do get questions here about how to play Japan. You know, one of the most easiest ways to do that is to buy the ETF EWJ. That's one that we have used in the past. I'm also kind of bullish on a company that's actually a Japanese company, Bridgestone Tire. You've seen them before, I'm sure. Pretty popular brand. They are pretty undervalued as of right now. That might be something to look into if you're looking to play Japanese stocks. Also, many of the regular, big cap, large cap stocks have risen pretty dramatically. There are still some areas that have not been as extremely bid up as other areas. And one of the areas I like in Japan right now are the Japanese property stocks. I don't expect Japan to, this whole crisis over there that they're having, to end well with all this new money printing that they're doing. But nevertheless, there'll be money to be made in the meantime. And I think Japanese property stocks are probably going to be an area that many people can make money on the second leg of this rally that's going on over there. Here in the United States, we have the Dow Jones Industrial Average. The rally that began last November remains intact. It's just continuing to go up. We have seen some recent consolidation just a few weeks ago. And consolidation simply means that the rally takes a break. It takes a breather. It doesn't mean that the market goes down, but it means that it just kind of moves sideways for a minute. It has to digest many of the gains that have occurred, and then it'll start either going back up or going back down again. And in the case of the Dow Jones, it began rising again. And we have been seeing tremendous amounts of continued upward pressure on the Dow, and a lot of it has to do with all the fresh money that's being put in by the Federal Reserve. It's that wealth effect that we've talked about over and over again. And, the Dow just burst right through that 15,000 psychological resistance. So it's at all-time highs. It's just really unreal. The S&P 500 index is also in a firmly upward trend, and it's very much intact. It remains intact. The volume overall that's been occurring in the major markets has been a little concerning. We are not seeing the overall volume the way we have seen in the past. And I'm talking 10 years ago, 20 years ago. Even though the stock markets are rallying, the people on Main Street, the average investor, is just not really participating the way that he used to. And that's still the case even now. So it's interesting to see all of this as we look at the rising price of these indexes. But we also see that the overall volume is just not nearly as high as it really should be. So that is a little worthy of taking note. The NASDAQ Composite Index has probably been the most on fire over the last several days. This week especially, the rally in the NASDAQ appears to be the most promising from a technical perspective as compared to the Dow and the S&P. The uptrend is intact. And as I look at the NASDAQ, I'm particularly bullish on the NASDAQ 100 index. I think you can definitely play that through an ETF. And the big tech names like Cisco and some of these other major technology firms, I believe they have not participated in this rally as much as some other industries and sectors have. So I'm particularly bullish on big tech as we go forward. I expect to see some gains there. We talked about Europe, the Euro Stoxx 50, which is kind of their version of the Dow Jones. You can also gain access to this through different ETFs. It's one of the most watched indices in Europe, and it represents 50 of Europe's largest publicly traded companies. Now, there was a recent announcement in Europe about an interest rate cut by the ECB, and that lifted the index after it spent about 4 months in consolidation. So I continue to be bullish on European stocks. The ECB has also made aggressive statements towards even more monetary easing, and so we expect that this index and many European stocks are going to continue to rise higher as Europe just continues to be aggressive. And remember, the euro currency itself has really held up well despite all of the problems that they've been having over there. A couple of years ago, everybody we brought on to this program practically was saying, oh, the euro is going to implode, the euro is going to go away. And we've always held that that wasn't the case, not because we're somehow prophetic or somehow able to see into the future, but really when you think about it, Europe is really the prototype for future world government. If you want to have a world government, you have to make Europe work. Europe has to work. I mean, you have all of these states that have been put together, these nation states, France and Germany and Italy, and, you know, of course, many of the northern states and many of the southern states that are more poorer. You bring them all together and you impose the single currency on them, the single political regime. And if you want to have a global government, you've got to make a regional government work. And Europe has been mired in this debate for so long, going all the way back to, well, you could actually go all the way back to the 1970s whenever this debate really began to creep up. But you really begin to see it since the inception of the euro and the debate leading up to the euro in 1999, 2000. And that is the euro debate between wide versus deep. You know, which way do we go? The people who want the euro to be wide, the eurozone to be wide, they want every country just to come in and then they'll sort out the problems later. That's kind of the ones who won. The other view is let's do it deep. You know, let's just take on a few countries, let's make it work, and then let's slowly add more and widen over time. Well, the people who wanted Europe to be wide, they won. And now we're faced with Barroso, and he is the current EU commissioner. And he recently said was that Europe is going to become a federation of states. A federal EU is on the way, and he's promising this. And we're going to be talking about a lot of what that's going to mean for integration with the United States through this brand new transatlantic partnership. We'll be talking about that in some of our upcoming FTM and quarterly newsletter articles and things like that, and also in our program. But Europe is intact. They're not going anywhere. They're a prototype for the future coming global government. We're going to see other regional governments like them. I truly believe this. And they're just the first of many before we finally get thrown into a full-blown global government. And that's not going to be a good day, because it's like putting everybody into the car with somebody who can't drive and then letting them just drive off the cliff. No empire has ever been able to do this. We don't have the leadership capability to lead the entire world, and nevertheless, they're going to try to do it, and the results will be devastating. Okay, over in Japan, the Bank of Japan, as I mentioned, is also doing a lot of easing. They have been juicing their economy through massive quantitative easing to the tune of $79 billion in bond purchases every single month. Now, Japan is they have the world's largest debt to GDP ratio. I mean, just massive amounts of debt. They're not the largest debtor nation in world history. That's the U.S. But on a debt to GDP ratio, Japan has the highest. They have a dismal economic future. No matter how you slice it, they have got to pay down their debt. And unfortunately, this recent move is going to be the final nail in the coffin, I believe, in the Japanese economy. The money printing is sparking massive buying in equities in Japan. It's sparking shorts against the yen. However, that has turned around the last couple of days, as some people thought the yen was oversold, but I don't think that'll last long. And this trend of shorting the yen and buying the Nikkei is intact. Some Japanese stocks have went up too quickly. We think we're going to see some consolidation. It might provide some nice, good buying points. So we'll be watching very closely on the Japanese Nikkei for entry points for those who subscribe to our Trigger Trade Report. The U.S. dollar, since February, the U.S. dollar has been enjoying increased demand because of the concerns over inflation by all of these other global currencies, like, as we mentioned, the ECB, the Bank of England, the Japanese bank, and then also now Australia had a surprise rate cut this week. And on top of that, the Bank of Korea had a rate cut this week. So, I mean, it's just like everywhere. There's this massive easing that's going on, and it's just going to lead to higher equity prices. So if you're not in equities, you're going to miss a tremendous amount of gains that are going to be made. Are they bogus gains? Are they paper gains? Are they illusory gains? Of course. Nevertheless, they are gains, and you have to take gains where you can get them right now in this market. The dollar is trying to rally this week. It's trying to get some strength, but I believe overall that it's going to continue its downward descent. It has been enjoying, though, as I mentioned, kind of a buoying effect, as the euro and the yen have had a little bit of difficulty as of late. But overall, the euro, by the way, I should mention, has really held up well. Despite all the problems that they've had, for the entire year of 2013, the euro has actually done pretty well, given all of the circumstances that are going on. Gold and silver, gold has been pretty disappointing as of late after that massive sell-off. It's currently in a consolidation period. It rose back up sharply, and now it's kind of consolidating. Silver is in the same place. It's trying to rally, but silver has been having a hard time as well. In fact, there was a new report put out by the Silver Institute showing that investment demand for silver increased by 21% in 2012. That was a record high. 160 million troy ounces last year investment demand. Compare that to 5.4 million ounces back in 2004, and you see the spike in interest by investors in silver. Now, part of the increasing demand is coming from the easier access that people have to silver through these ETFs like SLV and some of these other SIVR, some of these easy ETFs to gain access to silver. We also saw silver mining output rise in 2012 for the 10th consecutive year. So it just continues to rise. Nevertheless, the investment demand is also continuing to rise as well. And also, we should also take a look at natural gas. Natural gas is one of those commodities that we called back at the bottom. It formed a perfect entry point on the charts. I made a call. I said natural gas is a buy right now in our FTN quarterly newsletter, also with an email we sent out to our subscribers. And that thing provided a 100% return over the course of the last, 10 months or so. But regardless, the chart is now showing some points of exhaustion. The natural gas chart, the price has fallen now down to its 50-day moving average. It's trying to hold there, but I think by looking at the chart that now is the time to sell. So we are selling out of our natural gas position at current levels. We're selling out and locking in the profit. We may re-enter based on the chart, but right now we're locking in that 100% gain.
Gold, silver, palladium. If you have questions about or are looking to purchase precious metals, there is one name to know and one name to call. Tom Cloud at 1-800-247-2812. You hear Tom every week on Follow the Money Weekly, and gold and silver are an excellent hedge against inflation. Tom Cloud has over 30 years' experience as a precious metals advisor. Don't buy your precious metals through a call center and pay inflated prices. Call Tom Cloud, 1-800-247-2812. And for a limited time, tell Tom you heard it from Jerry Robinson on Follow the Money Weekly and receive free shipping and insurance on your order. That's right. Mention Follow the Money Weekly and your shipping and insurance charges are waived on your precious metals purchase. If you have a question about something you heard on the show, call Tom. And to secure your precious metals investment, call Tom. Your gold guy, Tom Cloud. 1-800-247-2812. That's 1-800-247-2812. You heard it on Follow the Money Weekly.
Well, joining me on the line today is my guest, James Galbraith. He is an economist. He's a professor at the University of Texas at Austin. He's also the author of several books, including his latest, entitled Inequality and Instability, a study of the world economy just before the Great Crisis. He has served on the staff of the U.S. Congress as executive director of the Joint Economic Committee. Professor Galbraith, thank you so much for joining me on Follow the Money Weekly Radio.
My pleasure.
You have a timely book, and I'm holding it in my hand right now. It's full of charts and graphs, and I tell you what, it's quite an interesting book. Before we get into it, there's a very interesting thing, a trend that's happening here in America. It's always gone on, but it's really intensified as of late, and that is that the topic of inequality has become so highly charged politically. It's always been a nice political tool, but I wonder why you think that it's reached the levels that it has, and it's become so demonized on both sides of the political aisle.
Well, I think the main reason is that everybody's aware that actual levels of inequality have gone up and that they've been going up for many years. And this opens up a political issue that wasn't there, let's say, 30 or 40 years ago.
You know, it doesn't matter where you look. I mean, if you look at wage inequality, CEO pay, homelessness, the education wage premium, I mean, if you look across the board at all the different metrics, inequality just seems to jump out. As you did this massive study, how was your study different in this book? What did you do differently?
Well, one of the things I realized a long time ago when I began to look into this is that the data, the information available, particularly when you go outside the United States and start looking around the world, just wasn't very good. And I developed a way, working with cohorts of my PhD students, to improve on it. And that's what we did, and that's what the book basically investigates, is what new body of information can bring to bear on the subject.
Now, your book subtitle is A Study of the World Economy Just Before the Great Crisis, and it seems as if most of us can't remember life before the Great Crisis. Well, what is the meaning of that subtitle, and what are you referring to?
Well, of course, when you do a body of work like this, you start with accumulated data, and those go back roughly to the 1960s. So the book covers the period from the 1960s up until the early 2000s, and that is leading up to the crisis of 2007, 2008. What we find is that there was a major surge in inequality globally, especially in the years between 1980 and 2000, which is an underpinning of much of what happened afterwards.
Okay, so the rising inequality, in essence, is partly to blame or fully to blame for the crisis. In your book, you do point out a lot of the connection between modern finance, stock markets, the development of some of the emerging markets, and then how that leads to inequality. Kind of explain that in layman's terms for our audience.
Yeah, I don't want to be too pedantic about this, but I'm careful about saying that one thing caused another. What I think I established in the book, is that the rise in inequality and the rising role of finance in the U.S. economy and the world economy are essentially the same thing. There are two ways of measuring the same phenomenon. And this is not something which had previously been well established and well recognized. But once you see that you're working on this one problem, which is the concentration of income that comes when you have an economy that is basically substantially uniquely directed by financial forces, by banks and banking institutions, then you have, I think, a much more insight into the kind of difficulties you're going to face.
It would seem as if the Occupy movement would embrace your message. Have you seen that to be the case?
Oh, I don't know. You'd have to ask them.
Well, the reason I bring that up is because they really do represent quite the polar opposite as the Tea Party. And this certainly isn't a political show. What I'm really driving at is how does your message compare and contrast to what the Occupy folks are saying on the extreme left and the Tea Party are saying on the extreme right? Where are they both going wrong? Because we all know that many people point to trade, to rising technology, and to other things, and they say that's what causes inequality.
The Occupy movement was quite careful not to have a program. It was kind of a movement in action rather than in manifesto and issues. So it's, again, a little hard to say how a book like mine, which is a study, relates to a movement like Occupy Wall Street. But I will say that there was a copy of my book in the library in Zuccotti Park, which got confiscated and trashed by the New York City police. So there was that connection.
Okay. Well, now, we talk about inequality, we do tend to think in terms of, I know in your academic world where you are, it's very different from where, some of the people on Main Street really are. They think in terms of, okay, my paycheck is just not simply covering what it used to. When I walk into the store, the size of the milk jugs are getting smaller, the prices are going higher. And so as they take a look at life around them, they see that they're just not getting ahead, and they obviously want to blame something, and they want to blame the rich. They may want to blame, something else. And in your book, you really bring out that it's this modern finance that seems to be in some way connected to this rise of inequality. Again, not to belabor this point, but if you can, help the layman understand the connection between the rise of modern finance and the rise of inequality. What is the connecting point? How does it connect?
Well, in the U.S., it's fairly straightforward. The major income gainers, the people who were getting richest most quickly in the period before the crash, were, in the first instance, bankers. And they were bankers who were originating mortgages, for example, and taking fees and counting the fees as income. And once you see that clearly, you can map it out across the country, and you can see that where the banks are headquartered is a major source of rising income, and where they're doing business is another major source of rising income for as long as it lasts. And so this is what's going on. And, of course, one of the unhappy consequences of relying on unscrupulous credit issuance as the source of economic growth is that it comes to an end. When the mortgages reset, when the banks realized that the paper that they'd been happily foisting on the investing communities of the world was worthless, when they stopped being willing to lend to each other, the whole thing came to a crashing halt. And we've been dealing with the aftermath ever since.
Okay, so people are rational creatures, and they're obviously attracted to what they view as incentives. And obviously, if you have a good degree and you're looking for a job, and you're offered a job in the finance industry, the next thing you know, you're climbing up the ladder. And the higher you go in the finance industry, obviously the more money that you can make. How do you prevent the inequality without completely just dismantling the modern finance industry?
Well, it's useful to start by enforcing laws, including laws that require honest dealing and protection against financial fraud. And one of the things that went on in this was that you had fraud underpinning practically every transaction in the mortgage markets. And that's not me saying that. That's one of the ratings agencies did a survey in 2007, and they found, to their surprise, that there was evidence of what they called abuse, fraud, or missing documentation in practically every file they looked at. Now, if you have legally enforced standards for what constitutes a fair mortgage, then you will forestall a great deal of that activity. But the message was sent very clearly from the supervisors, from the federal government, to the industry that those standards were not going to be enforced. And that is the very clear reason why the situation got as badly out of hand as it did. And then, of course, you have the whole enormous circus in which these mortgages were bundled, securitized, and sold off to investor communities with the imprimatur of the ratings agencies. So there was a chain of connivance in fraudulent activity, which we now see. We saw it again when the loans went bad, and there was a fraudulent bum's rush on the foreclosure process with a great deal of forged signatures and this kind of thing, fraudulent documentation. And we see it finally in the failure and unwillingness of the administration to put enforcement resources at work to deal with this problem. I mean, we basically have a Justice Department that's behaving like corporate defense counsel on the matter.
Well, and that's almost like the fox guarding the hen house, so to speak. It's almost beyond me how a solution can exist if the government has to be the enforcer. What's your solution to...
Well, the government is the instrument by which we write rules of conduct. They're called laws and regulations. And the government has the ability and the obligation to see that those standards and codes of conduct are enforced. That is the job of the government. You have a statute against burglary, a statute against murder. You count on the local police and the local courts to enforce those statutes. And the same has to be true with commercial fraud. The problem is that you have large institutions that are so powerful that at the highest level, the government doesn't want to move against them, even though it has all the evidence that it needs.
Professor, you've been studying this for some time, and I'm curious where we are now in 2013. Here we are in the spring. Have things, you've already alluded to the fact that things are not much better in Washington and Wall Street, but are things improving in any way from your perspective? Any bright lights or any bright spots of hope that you're seeing?
No, I couldn't point to one. I mean, I think we have seen that we do have institutions in the country which are continue to be fairly robust and which prevented the events of 5 years ago from turning into a downward spiral leading to a disaster. But we still have an enormous pressure coming from Congress to make things worse. The sequestration process is an example of that. And we have still an enormous reluctance on the part of the administration, as I say, to clean things up. And until they do that, country as a whole decides that it wants to have and must have a financial sector that is smaller than the one we presently have and that serves the purposes of the larger community, we're going to just, at best, we will stumble along in the present situation we've seen for the last 5 years, which is not, I can imagine disasters that would be worse. But this is a situation which is still very unsatisfactory from a lot of people's point of view, including 10 or 11 million people who don't have jobs who would like to have them.
So the type of calamitous type of drop in the stock market and, of course, the spike in unemployment that we saw the last several years, do you believe that enough safeguards have been put in place to prevent the same type of severity if we were to go through that again, or do you believe that we're ripe for another crash just like we had before? It's almost as if we don't learn. What's your take on it?
Well, it's hard to judge what would cause the same degree of panic in the financial sector compared to what we've had because the banks basically aren't doing anything. When you look at what the degree of the collapse in 08-09, of course it was a complete collapse of the construction sector. The construction sector isn't there anymore. It cannot collapse a second time. So I think I'm not one to say that we're about to see another massive downturn. I suppose I can't rule it out, but I don't have any good picture in my mind of how it would occur. What I can say is that we're not going to see a return to the situation of general prosperity, and so we still have a great many people who are in distress now and who will continue to be in distress, and that's by itself not an acceptable situation in my view.
We're running out of time, but just two more quick questions. Number one, the Federal Reserve, how are they performing in your estimation? Are they performing up to the task or are they failing?
Well, the Federal Reserve had the ability, which it used, to stabilize the financial institutions. It does not have the ability that many people think it has or would like it to have to, by itself, restore full employment prosperity. And so I think we've seen the limit of what the Federal Reserve can do. It's going to have to be other agencies and other parts of the community and of the government that take responsibility for improving matters from this point forward.
Mm-hmm. Would you say that Bernanke has done a good job given his environment, or do you think that he has not done a good job given his environment?
Well, it's hard for me to get over the fact that he was in place well before the crisis and clearly failed to exercise the authorities that he should have exercised at that time. Did the Fed respond, given how the situation it faced in 2009? The Federal Reserve certainly did a lot to prevent things from completely falling apart. And so, I have to give him credit for that.
Yeah. Are you seeing a spike in interest in economics at the University of Texas there in Austin? Are you seeing more students now that we've had this crisis? Are they genuinely more interested in how the economy works, or is it just kind of the same as before?
Those are two different things.
Yeah, it's true.
Being genuinely interested in how the economy works and studying economics are distinct.
That's so true.
In fact, almost totally separated activities. So I think, yes, people are more interested in how the economy works, but I hope this doesn't lead them to believe that economics departments are going to explain it to them.
Mm-hmm. Because in large part, the economics departments around the country didn't see the crisis coming either.
The economics departments were operating with theories and ideas that were completely helpless in the face of what actually happened. And that situation has not gotten better at all.
No, I would agree with you on that. The book is Inequality and Instability. One final question about the book. You make a pretty strong case that societies that do not suffer from inequality, like the United States obviously does, are more prosperous. And many people would say, who are living the good life in the United States would say, Professor, it's harder to find a more prosperous country on the face of the planet. How could the United States become more prosperous? And you say by becoming more equal. Give us a couple of ideas in closing on how the United States could become more equalized across the board. What are some of the fiscal policies or some of the regulations that could be imposed that could make this a better place to live?
I will leave you with just one. I would like to see a much higher minimum wage. This would help a great many low-income workers to live better and to be able to support their families. And it would also, I think, help small businesses in the country. They would lose something on the cost of labor, but they would gain it back on having a more prosperous customer base. And so that's a step that would definitely give us a stronger middle class, a more egalitarian society, and a stronger economy, in my view.
Very good. Professor, if people would like to learn more about you and your work, how can they do so?
No, they can certainly welcome to take a look at the book.
They can probably find it on Amazon.com.
I would highly encourage that, of course.
Yeah, Amazon.com, I'm sure carries it. Inequality and Instability, a study of the world economy just before the Great Crisis. My guest, Professor James Galbraith, and I want to thank you so much for coming on the program, and we look forward to having you back on possibly again soon.
My pleasure. Thank you.
Where's my money?
Money.
Daily bread.
Follow the Money Weekly presents the Retirement Minute.
Hello, everyone. This is John Burse with this week's Retirement Minute. According to an article in the Employees Benefit News magazine, LIMRA gave a test in recognition of April being Financial Literacy Month. They asked 2,000 Americans a series of 10 multiple choice and true and false questions to gauge their knowledge of basic financial and retirement topics. The study found that only 1 in 8 Americans correctly answered at least 9 questions, and more than a third, or 36%, failed, answering no more than half of the questions correctly. As Americans are required to take greater responsibility for their retirement saving, the issue of financial literacy becomes increasingly important, said Allison Salka, Corporate Vice President and Director of LIMRA Retirement Research. Our study confirms what previous studies have shown. People need more help understanding financial concepts. LIMRA has identified 4 ways that financial institutions, schools, employers, and the government can help Americans improve their financial knowledge. The first is educate early. 24 states have some type of financial literacy requirement for kindergarten through 12th grade education. Those who are exposed to financial education in high school tend to have a higher savings later in life. Our research found that younger people are inclined to overestimate their financial knowledge. Earlier education can help bring their actual knowledge level up to their perceptions. The second way that you can improve your financial knowledge is to educate at work. Basic concepts taught in school should be reinforced and expanded upon through worksite education programs. Many programs currently focus on transactional activities, how to enroll in a health or retirement plan, how to select investments, a more holistic approach that includes multiple sessions on life planning, topics like saving, debt, insurance, and retirement could be very helpful. The third way to improve your financial knowledge is to acknowledge and address differences. Men and women have different perceptions of their knowledge and different knowledge levels. Men are more likely to rate themselves as very knowledgeable. Differences in confidence levels as well as actual knowledge levels should be addressed as part of a targeted education program. The fourth way to improve your financial knowledge is to communicate resources. Make people aware of the many resources available to them, whether through a website, a financial institution, organization, or advisor. There are many ways to educate, help people connect with the one that works best for them. Everyone wants to make good decisions and retire with security. It is important that we all work together to help Americans improve their financial knowledge and make responsible decisions about systematic savings and retirement planning. This will help more people enjoy the retirement lifestyle they desire. So make sure your financial house is in order, and the best way to start is by contacting me at 1-888-914-9909, and I will be more than happy to review your financial situation with you.
All right, friends. Well, that brings us to the end of our program. Thank you so much for choosing to allow me into your life each and every week. It is an honor and a privilege to be a part of yours as well. And as always, I leave you with this final word, this time spoken by the Apostle Paul in the book of Philippians, chapter 4, verses 11 through 13, when he says, "For I have learned to be content, whatever the circumstances may be. I now know how to live when things are difficult, and I know how to live when things are prosperous. In general and in particular, I have learned the secret of eating well or going hungry, of facing either plenty or poverty. I am ready for anything through the strength of the one who lives within me. And friends, that person who lived within Paul was none other than the Lord Jesus Christ, who is the same yesterday, today, and forever. Thanks so much for tuning in. Remember, this show is dedicated to your personal, spiritual, and financial liberty. It's time to sign off, so have a wonderful and safe and prosperous week, and I'll see you right back here next weekend. God bless.
The views and opinions expressed by the guests on Follow the Money Weekly do not necessarily represent the views of FTMDaily.com or Makers Group Financial, LLC. Even though these are proven strategies, Jerry Robinson is not a financial advisor, and his guests are not legal or tax advisors. You should always consult a trained financial advisor and or tax advisor before making any financial decisions. John Burrs is a registered representative of and does offer securities through Sycor Securities Incorporated. Lifetime Decisions Management Incorporated is not a subsidiary of nor controlled by Sycor Securities Incorporated.